No, good morning, everyone. It is 10 o'clock, so we will call the May 13th, 2022 meeting of the OCERS to order. Item number 2 on our agenda is to receive the election report. We went through our normal process, requesting nominations for the required period of time, and everybody knew that they were running against Mr. Reese, so he scared them off, so he ended up running unopposed. So we are going to receive the election report, and as such, Mr. Reese will serve another term with us. So Chair will entertain a motion. Have a motion and a second. Please record your vote. Item passes. Before we move on, Dick, was Wiley planning on attending? Okay. Then we're just going to move along. Item number 3 is to approve the minutes of the meeting of April 14th, 2022. I have a motion and a second. Please record your vote. Item is approved. Item number 4 is the consent docket. We have one item. Have a motion and a second. Please record your vote.
Trustee Madera, how would you like to vote?
Item is approved. Item number 5 is to ratify approvals. We have 5 items. We can take those with one motion. Have a motion and a second. Please record your vote.
Yes.
Item passes. Item number 6 is to approve the claims docket. Have a motion and a second. Please record your vote. Item is approved. Item number 7 is to approve the following applications for service retirement. Have a motion and a second. Please record your vote. Item is approved. Item number 8 is to receive report of death, approve continuation of pension to spouse. Have a motion and a second. Please record your vote. Item is approved. What I'd like to do now, I've had a request to move our executive session item, which is item 13G, to move that up. So Chair will entertain a motion.
I'll make a motion
executive session? I have a motion and a second. Yeah. Record your vote.
Trustee Lawson, how do you vote?
Item is approved. A motion is approved. We will retire to executive session and return momentarily. All right, we are back, and we return to the agenda. We are on item 9, receive report of death, authorize payment of the $5,000 death benefit. Have a motion and a second. Please record your vote. Item is approved. Item 10 is receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes. Motion and a second. Please record your vote. Item is approved. Item number 11 is receive report of death, authorize secretary to make necessary changes. Motion and a second. Record your vote. Item is approved. Item number 12 is to approve the following application of vested rights. Have a motion and a second. Record your vote. Item is approved. Item 13 is items for individual consideration. Item 13A is to approve sending attendees to the Oklahoma Public Funds Trustee Education Conference. I have a motion and a second. Record your vote. Item is approved. Item 13B is approval of sending attendees to the International Foundation of Employee Benefit Plans training program to pursue certificate in public plan policy, June 6th through 9th, Santa Monica, California. Have a motion and a second. Please record your vote. Item is approved. Item 13C is approval of sending attendees to the National Association of Public Pension Attorneys 2022 Legal Education Conference, June 21st through 24th in Louisville, Kentucky.
For full disclosure, I want you to know I have requested to attend, but I do intend on retiring in August of this year. But hopefully we'll be able to work out something where I'm retained as a consultant from time to time in the future. So, but I did want you to know that I won't be feelings hurt if you decide not to send me, but I would like to go.
We have a motion and a second. Record your vote. Item is approved. Item 13D is to receive the quarterly investment report. Good morning, Jason.
Good morning. Thank you. Paul, there's a few things that you have in front of you this morning, so I'll touch on the quarter report and then a little bit on the monthly report. We also have a recommendation for a value-add real estate fund. First thing I wanted to just point out, I handed out today a memo that hopefully you all got. I know it went out in the email a couple days ago from our director of research, but I just think it's relevant. I wanted to make sure everybody saw it, and I'm going to hit on a few of these items. But so as we're experiencing the downturn in the market over the first quarter, having conversations with clients that you know, everything is down. This is one of the first times in a long time where we've seen stocks and bonds down at the same time. The only thing that's positive is real estate, and it's really because you haven't seen marks flowing through portfolios. That said, it's important to keep the perspective of what's happened the last really 14 years since the financial crisis in 2008, where we've had, you know, a substantial amount of fiscal stimulus and monetary stimulus, where the Fed has kept rates very, very low, coming into, as COVID happened in 2020, there was massive amounts of fiscal stimulus that were pumped into the system, and that really pushed up asset prices dramatically. Now we're seeing the impact of that. You know, there's no free lunch forever, and we're really seeing a re-rating in markets, and it's somewhat coming at a time of a perfect storm, as you have still the impacts of COVID and lockdowns in China that is continuing to exacerbate supply chain issues, and coupled with a major world power invading another country that is causing concern. But I think what's important to keep in mind is where we've been, and as we look at the quarter report, and if we just go to page 24, your 10-year return through the end of March is up. The total portfolio there at the bottom, 10 years through the end of March, 9% annualized return over that 10-year period. Those are very strong returns, and in excess, really, of what we would expect this portfolio to deliver based on our capital market assumptions, even at that time, just to show how strong things are. Your portfolio's in the top 20% of public pension funds over that 10-year period. If you just roll forward a couple pages, Regina, one more. Yep, this one. So this is looking at individual rolling one-year periods ending in March, and we can see this last one-year period that just ended this past March, very muted returns. Portfolio net of fees up 3.5%, trailing the policy index by about 4%. There's really a couple things going on there that we've talked about and we'll touch on a little bit more. Primarily, it's within large cap. Over the last year, your large cap allocation with the Intech strategy, a little bit more weighting in the smaller names within the large cap universe. That was a headwind, really more so in 2021 than calendar year 2022 so far, but that was a bit of a headwind. Then the non-US equity portfolio, specifically sell-off in emerging markets, had some impact. But if you look at that one-year period ending March of 2021, that is the 1 year coming off the bottom of COVID. So COVID, the shutdown of COVID, I was here in Oklahoma City coming to your meeting when it was the last meeting I went to. It was like March 13th of 2020. So that's 2 years. The 1 year period from then, your portfolio was up 38% net of fees. Our capital market assumptions on an intermediate term basis, so for the next 5 to 10 years, for your portfolio mix, is an expected return of about 6.5%. So if we think of that 38%, that's really 6.5 years of returns pushed into that 1 year period. So seeing a re-rating of markets, not surprising. And we all need to be aware that there's probably a little bit more pain to come. Fed funds rate now is at a little under 1%, 75 basis points with the 2 raises we've had so far. Historically, if we go all the way back to really prior to 2008, the average Fed funds rate was closer to 4%. So we're a long way from that. And with inflation at 8%, there's probably a lot more work to go to get rates higher to stem inflation. And as rates move higher, valuations on stocks have to come down. That's really what pushed valuations on stocks up. As yields coming down, PE multiples were just rising, and what we're seeing with rates rising to get back to where they really need to be to stem off inflation and slow growth a little bit. We have to get back to a more normal place, and that's PE valuations closer to 16 times on the S&P 500 and as well as small cap stocks. Despite the sell-off, large cap stocks are still on a relative valuation basis. The PE multiple is still above what the long-term historical average is, despite being down close to 20% on a one-year basis. So I think just trying to provide some perspective of how strong markets have been, what we're seeing now, while painful, it's not to be unexpected. If we turn to the monthly update, touch on a couple things that you already just heard me say. The first page, Regina, first slide with data on it. You'll see there in the upper or middle of the page, market returns. This is on year to date and for the month. April was a really bad month. The dark blue bars are the 1 month returns. So going to the bottom of this, small cap stocks were down 10% on the month through April, down almost 17% on the year. Large cap stocks, as the S&P 500, was down close to 9% on the month and 13% on the year. If we bring that forward to today, small cap is down over 20%, which would be considered a bear market. Large cap, not quite down 20%. But you see emerging markets, international is measured by the EFI, all down about 12%. So everything on a year-to-date basis down about 12%. And then bonds, the Bloomberg aggregate benchmark down 9.5% year-to-date. This is the one thing we really haven't seen. If we go back to 2008, the last major market correction, and even 2020 with COVID, we came into that, yields were higher. So this is really a re-rating episode as opposed to what we saw in 2008 with the unwinding of the housing, leverage in the housing market in 2020, with which just a global shutdown of economies. We're seeing stocks down 10 to 12%, but bonds down 10%, which is, in those periods, we didn't see that. It was actually, stocks were way worse. Stocks were down 40 to 50%, but bonds, for the most part, at least in 2020 with COVID, because treasury yields fell, so bond prices went up, you got a positive return from bonds. In 2008, a little bit different because it was a credit crisis as well, but still the treasury component, as treasury yields came down dramatically from a higher starting point, you still had basically a flat to slightly positive return in bonds. So this is a little different than what we're seeing. You'll note here what I was mentioning with respect to valuations there in the middle of the page. The current PE on the S&P 500 is 17.5 times earnings. That's still above the historical average PE on the S&P 500. So as much as we've sold off, still expensive relative to historical. Small cap is looking a little bit more reasonable based on a comparison to historical valuations, and international emerging are in line. All of this said, and as mentioned in the memo by our Director of Research, as we move forward, and I know this is somewhat hard to appreciate when you're in the middle of the storm, but as we revisit asset allocation in 2023, our expected returns for long-term investors are going to go up. As a long-term investor, you're better off from a starting point of higher yields and lower valuations. It's a better starting point. But as we weather the storm, it's challenging. But you've had 10 very strong years. So just turning to your portfolio on page 11, I thought it would be good. We added this 2-year column here because it really, we have to look at this, what the last 2 years as one. This is from the trough in March of 2020 with COVID to the trough today. and you'll see your total fund over that 2-year period through the end of April, as painful as this first quarter has been, is up 13.3% over that 2-year period, and ahead of your policy index. The 1-year period has been, well, it's been dreadful. It's down 4%, but you had such strong returns coming in from the year before that what we've seen is really an unwinding of that. And the areas that did the best have sold off the most. Your large cap portfolio trailing the benchmark by about 4%. Long short equity, we've talked about. This is really challenging, and there's a few things going on there where we would expect long short equity to provide protection in a down market. Over this 1-year period, a big part of that is not being up as much in the early part of this 1-year period. So with the meme stocks going up, your long short equity wasn't up, it was flat, wasn't negative, but it wasn't up when other public markets were up. And then in just the positioning of this portfolio, while it had much lower market exposure, about 70% market exposure, it was leaning a little bit growth, particularly technology, and smaller cap than broader markets. And that was a big headwind really coming into the beginning of the year when you started to see rates going up and that growth and smaller cap really sold off. Got a little protection in the month of April, and going forward, we're still constructive here, but it's no doubt been challenging. Your private equity, as we're building that portfolio, has done very well. Last year was a very good year for private equity. You don't get the same volatility in your private equity portfolio because it's not mark to market. So from an experience standpoint, it actually helps when markets are selling off. We would expect some of the quarterly valuations for the first quarter. There's a lag. We'll start to see March marks for your private equity portfolio this month and next month. There'll probably be some markdowns in those portfolios just to reflect reality of public markets. The international portfolio, certainly, if you look at the 2-year, again, both international and emerging, up basically in line with the benchmarks, but the 1-year has lagged quite a bit, and most of that was Allspring, the emerging market manager, in the second quarter of last year. So that June to September quarter, with China introducing some legislation and policy regarding the for-profit education. They had some exposure there, and that was a big headwind. But you see, over a 2-year period, we've outperformed, or basically outperformed in emerging markets and in line, a little bit behind for developed. Your fixed income weathered the storm fairly well, I'd say, over a 2-year period, basically flat. We're doing some things there to have less rate sensitivity. The PGIM portfolio, or the liquid absolute return strategy, that's actually, over the last year, it's positive, has a 20 basis point positive return. So they have very little interest rate sensitivity in that portfolio, and that's what it's designed to do. So looking at that, on a 2-year basis, to say down 77 basis points for bonds is good. It's better than being down the 5% that the market is, kind of what we've anticipated. And then real estate has done very well. What we've seen, particularly in the U.S. economy, the economy is still running pretty hot, and that's a big reason why you're seeing rates having to rise. Employment numbers continue to be very strong. You're seeing wage growth. You're seeing areas. One of the biggest areas of inflation is in multifamily or apartments. It's very hard to find a place to live at an affordable price. So if you're a renter, that's a tough thing. If you're a property owner, it's been a beneficial thing, and that's a big part of the return over the last year has come from that multifamily ability to increase rents as those leases roll over, as well as the industrial sector or warehouse, and that's been very strong. So looking at a one-year basis where everything is negative, your two private markets areas, private equity and real estate, holding up nicely there. One item of concern with respect to managers, if you just go to the next couple pages back. So Times Square, this is not performance related. Times Square has been in your portfolio about 12 years now. They're a higher quality growth manager. Since inception, they've done a nice job, a little bit ahead of the benchmark, about a 13% annualized return. The last few years, they have had some turnover that we've talked about on the team. It's primarily been analyst related. Just in this last week, it was announced that one of the founders of the firm and the co-PMs on this strategy is going to be retiring in 2023. That coupled, we have seen some asset flows, some actually fairly significant asset flows in the portfolio, where not just market losses, but investors getting out. That has caused us some concern. So we are suggesting that we look at other candidates to replace them with. This isn't an emergent situation today, but it's something that we think we should get in front of. So our plan would be to come back to you next month with some information on some other candidates to look at that we possibly interview in June. You know, we talk a lot about being patient with managers, and we are with respect to relative performance, because we know performance will cycle based on their approach to the markets and what their philosophy is. But we're a little less patient with is more qualitative issues when you start to have turnover in people and assets that might affect the firm. That's something that we feel like we need to move fairly quick on. So we'll be back with more information on that next month.
Okay.
Any questions on that before I turn to the real estate recommendation? So I said last month when we made a private equity fund recommendation that it would most likely
Jason?
be the...
Excuse me, let's go ahead and vote on items D and E. So let's have a motion on item D to receive the report. Have a motion, a second. Record your vote, please. Item passes. And now item 13E is to receive the monthly investment report. Have a motion and a second. Record your vote. Item is approved. Oh. Item is approved. And now we will go on to item 13F, which is real estate portfolio discussion and review of recommendations of the $10 million commitment to Blackstone Real Estate Partners 10.
Okay. So just a reminder, because it's not in this real estate piece, but you have your target allocation overall is to 65% equities, and the equities are broken down: U.S. large cap, small cap, long short equity, private equity, international and emerging. Then 20% allocation to fixed income and a 15% allocation to real assets. The real assets allocation is intended to be 10% in what we consider to be core strategies. These would be strategies that are very high quality in an open-end fund structure, meaning you can get in and out on a quarterly basis so long as there is liquidity, and that is the Morgan Stanley Prime Property Fund. You then have a 5% target allocation to opportunistic real estate, or more broadly, non-core real estate. That 5% is going to be in vehicles that operate like private equity funds, and that ranges the spectrum. If you go to the next page, Regina, a couple right there. So what we're talking about here really is the value add and opportunistic. In your target allocation, it's just referred to as opportunistic real estate. It's really what we're talking about is the non-core piece. So expected returns for core are really 6 to 9% over the long term. As we move out on that risk spectrum, it's more 8 to 12% returns. So we're seeking a little bit higher return to enhance return, but in recognition that they're a little bit more risk, that allocation is a little bit smaller. And it's going to be built through multiple funds over time. If you go to the next page, you see here kind of how they plot out on our risk return spectrum. This is your portfolio. The Morgan Stanley Prime Property Fund is there on the left. That's core. Over time, you have made commitments dating back. The first was in 2013 to TA Associates, and then in 2017 to the Singular Gulf Distressed Real Estate Fund, and then more recently in the last year to Starwood and Angelo Gordon. And you can see where those plot out. These are all doing a little bit different things. The Singular Gulf Distressed Opportunity Fund and Starwood, that is a distressed opportunity fund, really trying to take advantage of dislocations in the real estate market when they occur, and buying things that are a little bit more distressed and need heavier lift to get them.
Jason?
Yeah.
If I was building a hotel, let's say, where would I fit in this? If I was looking for investors and looking for us to invest in something like that?
If you were building a hotel, probably not with any of these funds. But however, some of these funds will invest in hotel.
Okay.
At different points in the cycle. And
Right.
actually Blackstone, the fund we're talking about, they will, in this fund, we believe they're going to have some opportunistic investment in hospitality because of the distressed nature of it.
Right.
Starwood as well.
Okay.
And Starwood, that's where they came out of. The Starwood group, that was a lot of hotel.
Right.
Yeah.
Historically. But both of those funds are going to be diversified. But they may not be alongside somebody building a new hotel. It may be looking at property hotels that are already built in areas where they think they can buy them cheap.
Where I was going with this, I was trying, if you go back to the previous slide, I was trying to see what the expected returns are. That's kind of what I was just looking at for some other things that we do at the city. So I was just wanting to see if I could utilize that. So thank you for.
Yeah, it would be the value add and opportunistic depending on where. Okay, so just keep going forward there. So again, this is the bottom is probably the most relevant. This is where we are to date in your non-core opportunistic portfolio. You've committed $40 million since 2013 to those 4 funds. 2 of them are relatively new, the Starwood and Angelo Gordon. They've drawn to date about 14.8 of the 40 million. There's still about 25 million remaining. But again, you're underweight to that 5% target for the opportunistic. We're at about 1.5% invested today. If you go on, you've seen this as we talk about private equity. It's a pacing model for these private market investments. What we're doing here is trying to come down on a number that we think is reasonable to commit in any given year. Again, you're not putting that money to work that year, but we're committing it to funds that are raised during that year, knowing that they're going to call down that capital over the next 4 to 5 years to get to a 5% allocation in a reasonable amount of time without getting too overcommitted. And so based on our analysis, we think a $20 million commitment pace at this point in time, based on current values of the portfolio, would get us to a 5% target in about 5 years. As we know, these numbers are going to change. We're going to look at this every time we update this and bring a new recommendation to you. right now, what we've seen is real estate has become a bigger portion of your portfolio at the end of April, the end of March and the end of April, because stocks and bonds collectively are down 20% for stocks and 10% for bonds, and real estate hasn't really moved, and that's more a function of accounting. So we're a little bit over our target to core right now, but we know this will move. But we think a $20 million pacing plan is very reasonable and won't get us too far out over out in front of ourselves where we'd be overcommitted, and it's a reasonable amount to get to that commitment, that target allocation within a 4 to 5 year period. So why don't we just move forward to the Blackstone slide? One more. There we go. So this is a summary of the Blackstone strategy. Blackstone is the largest real estate manager in the world. They have a significant presence across all sectors of the real estate market and globally. 2,400 employees and 32 offices. This is their 10th real estate closed-end opportunistic fund that employs an opportunistic strategy. They're really, they're not going to be limited to any one sector or area. It will primarily be in the U.S., but they are really going where they find opportunity in that current market environment. They're going to do big transactions because of their size and their breadth within the real estate markets. They can really do very large deals that no one else can or no one else will even look at, and they can move pretty quickly to do them, which we think is pretty attractive. They're doing deals between $100 million and $2 billion, so these could be very diverse portfolios of hotels or portfolios of apartments or portfolios of warehouses that they can put in place and move very quickly. Their track record is outstanding. It's on the next page. Going back to their first fund, which was raised in 1994, through their most recent fund, you can see the net IRRs all well above 10%, or the 12% target that we're looking for. For the most part, these are all in the top quartile of other real estate funds, at least they're mature funds, with the exception of the 2003 fund, which was in the above median on a total value and a distribution to paid in ratio. The IRR was a little bit lower, and that's because they were patient in selling. They didn't force sales before the great financial crisis in 2007. So this was investing company or properties that really you would have expected them to have to sell in 2007 or 2008. You couldn't, so they waited. They were able to get a decent multiple on their investment, but that lowered the IRR a little bit. But long term, this very strong returns, north of 12%. So I think this would be a very good complement and to add to your non-core real estate. And we're recommending, it's on the next page, a $10 million commitment to this Blackstone Real Estate Partners 10. We think the closing on this fund is going to be quick, just like a lot of the others that we've talked about. It will be one and done, and this one will be in June. And I think with Angelo Gordon that we did earlier this year, this really meets our pacing plan for the year at $20 million, and we think it's a really compelling opportunity.
Anyone have any questions for Jason on that? Hearing none, Chair will entertain a motion.
Can I have somebody say that motion out loud, because it's not really
It's not working.
clear? Well, no, I'm just saying I want it repeated what the motion is.
Okay, we need a verbal motion on item.
I'll make a motion that we invest $10 million into the Blackstone Real Estate Investment Partners number 10.
Well, are we
Right.
voting to invest, or are we voting just to receive the recommendation?
That's where I wasn't clear.
I think
What do you
we
wanna do?
vote to commit the $10 million.
Won't we have another item to come back to actually allocate the funds? No? Okay. I'm fine with it. I just want to make sure what we're voting on.
It's a $10 million commitment,
Right.
which then then the staff fills out the subscription documents to make that commitment.
Okay.
And then the money is called over the next 5 years.
Okay.
So I'll make the recommendation of a 10 million, I'll recommend a $10 million commitment to the Blackstone Real Estate Partners Fund. I'm waiting right now. There we go.
Have a motion and a second. Record your vote. JC second. Item is approved.
I'm gonna try to fix the second one.
Okay,
Thank you, sir.
thank you.
Okay. We've already voted on item 13G. So item 14 is comments from board, staff, and citizens. Thank everyone for adjusting your schedule to meet our Friday date. And we are adjourned at 10:51.